The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to today's webinar. This is Andrew Wilkinson, Director of Trading Education with Interactive Brokers, coming to you live from New York State. Hope you're all doing okay, and I'm delighted to have with me today from the CME Group, Craig Buick, who's the Senior Director of Client Development and Sales. He's going to be talking about tools for active traders, generally available from the CME's website, but he's going to go into great depth on that. He's got a great lineup of tools to use for active traders. We'll welcome Craig in a moment, but before we do, I just want to remind everybody, if you've got any questions throughout the session, please put them into the question panel, and Craig will be able to see them at the end of the session, and we'll get into a Q&A. And just to remind you that today's session is being recorded, and that about 2 hours after the end of today's webinar, you will receive in your inbox a link to the recording. So if you have to quit early or you couldn't make it and you're listening to the recording, it's in your inbox. And we also have a handout from Craig, which is in the handout section of the GoToWebinar user panel. And I've just put up on the screen there the IBKR disclosures. So with that said, I am going to hand this presentation over to my colleague, Craig Buick. And here we go, Craig, I'm going to hand over to you. Change the presenter to Craig. Craig, you have the control of the screen. And if you want to put up your screen and presentation, okay. Open up the toolbox and show us what's inside.
Sounds good. Can you see that now, Andrew? Am I sharing my screen?
Perfect.
Great. Well, I appreciate the introduction, and on behalf of CME Group, I'd like to thank Interactive Brokers, not just for this webinar, but for being a great partner to CME over, really over decades as we work to educate the trading public on CME Group futures and options products. It's been a pleasure to work with Andrew and IB, so I appreciate that. And of course, I'd like to thank everybody for taking a little time out of your day to listen to what we have to say today. I think it's a unique presentation in that we're not focusing on a specific product or asset class that CME Group lists on the exchange, but rather a suite of software tools that quite frankly, if I go back to when I started in the business 25 years ago, and really probably 10 years ago, I'm going to show you some software that I think probably represents what would have been thousands of dollars in sort of expenses that we now offer for free. And nothing I'm going to show you today isn't available on our website, for free, just for logging in. So I hope that it's a valuable presentation. I think it is, and hopefully you take something out of it. So with that, I'm going to leave the disclaimer up just for a second here. I'm not going to read it. But I think that the point we want to make here is that while we obviously think that futures and options on futures are a valuable part of any trader's toolbox, they do come with different risks and different nuances and characteristics than some other financially traded products like stocks and even options on stocks. So we do encourage everybody to really do your homework before you start trading futures and options. And we have a lot of available resources on our website. I know Interactive Brokers does as well, but we do encourage that. And once you do, and you've kind of gotten the sort of basics down, the basic mechanics down, like we said, I think it can be a very valuable part of a trader's toolbox. So with that, I'm going to show you, and we're not going to go over every tool that I have listed here because it would just take too long, but I do have the URLs for each one on the different slides, which Andrew mentioned will be available. So, but we will go into detail on some of these. I mean, they're kind of two categories. The ones that I have in front of you on the slide are tools that kind of are applicable to across asset classes. So whether you're trading interest rates or agriculture or anything in between, these tools can be used for those products. And then we also have some tools that are sort of asset class or product specific, and we'll go over a couple of those as well as we go along here. So with that, let's dive into it. And before we get into the first tool that I'm going to show, or first software product that I'm going to show, I wanted to do a quick lesson on what's implied volatility. And the reason I want to do that is, one, because a lot of the tools that I'm going to showcase have implied volatility underlies the functionality of the particular tool. So I want to make sure that everybody understands what implied volatility is and what it means. And then also, just because implied volatility is such an important part of trading options, that, you know, if you're contemplating, or if you're trading or contemplating trading options, it's just an element that you just have to understand, I think, to be effective at it. So with that, I've got in front of you what I would consider known elements to pricing an option. And the way I think of implied volatility is a little bit different than, you know, what you might read a lot, which is that implied volatility is an input to an option pricing model like Black-Scholes or Whaley or any of the standard models. I kind of think of implied volatility as something that sort of falls out of the model. And what I mean by that, and to be clear, if you're doing an academic exercise to figure out, you know, what the implied volatility in a particular option is, or what the price of, what the theoretical value of an option is, certainly you would have to put implied volatility into that, and then it would spit out a theoretical price. But in reality, in kind of trading reality, the price of the option is known because it's determined by the market. And so what I've got in front of you here is simply a screenshot of CME Group's provided trading front end, what we call CME Direct. But the reason I've got it up is because I've got on here the different elements that go into pricing an option. So you can see days to expiration. In this case, I picked an option that had 22 days, and you can see that up here on the left. You know what that is because you've picked the expiration. You've chosen that. Same with the strike price, right? In this case, we're looking at the money 1710 in the gold option. But you've picked the strike price, so you know what that is. You know what the futures price is because that's determined by the market. In this case, it's 1709 spot one. And then in reality, you know what the option price is because that's determined by the market. So in this case, we've got a market of 33.2 at 33.7. So that's what the value of that option is at that time. That's what the market has determined. And you can look that up on your trading front end. And then of course, the risk-free interest rate goes into pricing an option, but you know, that's a little bit of a more minor consideration when you're pricing an option. It comes into play in the fact that if you, for example, purchase an option, you spend that money up front, you actually pay for that option in full in most cases. So there's a time value to that money that you put up. With rates as low as they are today, like I said, it's a little bit more of a minor consideration, but it's a consideration nonetheless. So this is all stuff that you know, like you know this when you go to look to trade an option. So what don't we know? Well, all we really don't know is how much the underlying future is going to move between the time that you buy that option or sell that option and the time it expires. So the value of that option then is determined by the market consensus of how much it's going to move. And that's what we mean, you know, in other words, what the market is implying, implied volatility, is implying that the future is going to move. So in this case, at that, you know, those same prices that we were just looking at, that 30 at, you know, 30 spot one at 30 spot 5, that implies a volatility of 18.3%. Now that's an annualized number, just to keep in mind, that's what implied volatility is. But that's, to me, that's what implied volatility is. I didn't put 18.3 in to get that, although obviously it's a little bit circular. If I moved implied volatility up, the theoretical value of that option would go up. But the volatility sort of falls out of the model, in my opinion, because the price, like I said, has already been determined. Maybe put another, to illustrate it another way, this is, and this is actually kind of accidentally getting into the tools, one of the tools we have, but this is just a strategy builder that's available on our website, where you can kind of do what if scenarios with different options. So in this case, what I've got in front of you is the implied volatility in the price and the days to expiration that we just looked at. And you can see that up in the summary that it, you know, the price of that option is 30.3, and then the implied volatility of 18.3. Now, on the next slide, what I've done is rather than change the implied volatility, I changed the price. So let's assume that nothing else changed in the market, but the price went up. When it went from, oh, what did I just say, 30.3, and the price rose. Now, I exaggerated this for sake of illustration, But let's say that nothing else changed but the price, and I did that here in this box, went to 35. Well, now all of a sudden, we have an implied volatility of 21.6. Nothing else changed, but the price went up. That means that the market is implying, again, if you will, that the market's going to move more than it was before. And again, volatility doesn't tell you direction at all. It just tells you the magnitude of the move. But hopefully this helps at least give a little bit of a background on what implied volatility is. So with that, let's get into the first tool. The first one's pretty simple here. And I'll admit that I use corn in these examples, and these slides are now a month or two old, but I think they're still fairly relevant here. And I used corn, like I said, and you'll see it in the next slide because it was good for illustration. But what you've got in front of here is in the blue line there, I've got 1 month of implied volatility information for the corn futures or corn options market. And you can see that in 1 month, implied volatility in corn has gone from 30 to about, approaching 40%, right? Which is a fairly big move, especially if you look at it in percent terms. Now, in and of itself, if I were to tell you that corn was trading at 37%, let's say, and then I was to tell you that Bitcoin was trading at 80%, well, you might think, wow, well, corn volatility is actually pretty low because compared to Bitcoin. Well, you have to look at these things in a historical perspective. And if you do that, you would see that, if Bitcoin is trading at the sort of 70 to 80% range, it may be a little bit high for Bitcoin, but it's actually traded up to, I think, 120, 130% in January. So that's actually come down a lot. Whereas corn, as we're seeing in 1 month, has gone from 30 to 37. Seems like corn has increased. Maybe that's actually relatively high implied volatility for corn. But that only tells you part of the picture. So what this tells you, and it's a nice picture to know, it tells you in the last month that implied volatility in the corn options market has risen and fairly substantially, but it doesn't really give you a lot of historical sense. So another tool that we have available allows you, and this is a little bit harder to read, I know on the slide, I wanted to show all 4 years here, but I'll explain it. And so this tool shows you what the current implied volatility is. So I'm looking at the March of 2021 implied volatility in that sort of orange brownish line, however you want to call that color. And then days to expiration is on the bottom. So as we kind of move right to left, actually, the days to expiration gets smaller. So at the time I did this slide, we had, I don't know, maybe 15 days until that March contract expired. And you can see the top left graph is comparing the current, which is the 2021 implied volatility, to what the 2020, March of 2020 contract was 1 year ago. And that's the blue line. So you can see with a similar days to expiration, last year, the implied volatility was down around 15% in corn. Whereas this year, it's actually the March volatility when I did this was about 40%. So more than double what it was last year. Well, now that gives you a little bit more information than you got on the previous slide, which is, okay, so this year implied volatility seems to be pretty high. Well, let's do the same thing against 2019. And again, you can see, again, corn volatility at the time I did this slide a couple months ago was significantly higher than it was in 2019, 2020. And then obviously you can see that 17 and 18 kind of tell the same story. So now I've gotten more of a historical picture on what the current implied volatility of corn options really is. And you can see if you combine kind of what we saw over a 1 month period, which is it rose, and then you compare it to the years prior, you can see, well, yeah, we seem to be anyway in a pretty elevated implied volatility situation in corn options. And that's important information to know because, one thing I didn't mention when I went through implied volatility is that, and if you're unfamiliar with the topic, it's important to know that if I hold everything else in an option equal, days to expiration, futures price, everything equal, but I raise implied volatility, well, the price of that option is going to go up as well. So if you're buying options and you're buying options in an elevated implied volatility environment, well, you're going to need that future to move more if you're doing it in a speculative way. in order to make money than if you were buying options in a low volatility environment. Now, of course, there's a reason that implied volatility is elevated, and that's because the market consensus is the futures price has the potential to move more. But you should know, though, that, again, when you're buying high volatility options, all else equal, they're more expensive. So I think this is very important information to know, and I think this tool gives you a very good historical perspective on where implied volatility is versus where it's been. So another volatility concept that exists in options trading is that of skew. And skew has a couple different meanings, but in this case, we're talking about skew as the relationships that calls have with puts. And it's a bit of a historical sort of lesson. Skew really entered the options markets in earnest after the stock market crash in 1987, where sellers of puts started demanding more premium for puts than they did for calls, with the idea that a big price shock to the equity index options markets would more likely come in a downside move than an upside move. So if you go back and look at, and this is what we call a risk reversal in front of you, which is basically I take the volatility of the 25 delta call and I subtract the volatility of the 25 delta put, and that gives me the relationship between the sort of out of the money calls versus puts. Now in this case, that orange line you see represents, and this is a very similar graph to the one we just looked at, where I compare the skew, when I did this slide for the 2021 contract. And again, you can see a little bit more clearly here. Here's days to expiration on the bottom. You can see that at the time I did this, the calls were actually trading at about 3% higher implied volatility than the puts were. So the market was demanding more to sell a call, or buy a call rather, than it was for a put. Now, obviously, the insinuation there is that the market is assigning a greater probability to a price, shock to the upside than to the downside. Now, does it mean that it's going to go up? Of course not. But the options market is saying, I'm going to require more premium to sell you a call than I am a put at the same delta. So that's good information to have, I think, regardless of whether you're trading options, because it just tells you what the options market is saying about the potential price move. And you can see on this graph, I compared it to where the skew was back in 2015 here, which is the blue line, where the calls and puts were really trading about the same volatility level. So this here you can see, as opposed to 2015, the market's assigning more of a skew to the calls than they were to the puts. Now, what I was starting to say before is that if you look at equity index options, that number's, since they started tracking this really back in the 80s, that number's always been negative, because ever since the skew sort of entered the markets, in equity options or equity index options, the market has always assigned more of a value to the puts than the calls. So that number, if we were looking at equity index options, would always be below that zero line there, because calls minus puts is going to give you a negative number. So it depends, the product that you're trading is going to determine, kind of where the skew is, where, in commodity markets, even in the graph in front of you, you can see that, the blue line back in 2015, the skew is positive and negative. That's kind of the same thing that you'll find in commodities like WTI or gold and things like that, where sometimes the market assigns a bigger likelihood of a price shock to the upside than the downside, where as in equities, they've almost always assigned that, probability of a shock to the downside. So that's that tool. I just wanted to, because we looked at, the corn volatility over the last few slides, I wanted to point out that CME Group, because we don't talk about it quite as much to the sort of active individual trader, but CME Group has an entire suite of agricultural products that include corn, wheat, soybeans, oil, meal, and then things with feet like cattle and hogs, and then we have options on all of that as well. So, I think these are products that are worth looking at, because, we might enter a situation where implied volatility in equity options, winds up in a sustained low volatility environment, but your trading style suits, is better suited to a high volatility environment. Well, because all of this stuff is cyclical, you might not find as much trading opportunity at a given time in some asset class like interest rates or equities, but maybe agricultural products, or because of weather or demand or something like that, are experiencing a period of high volatility, and these products are, might be worth looking at. So moving on with price and volatility tools, there's another concept in implied volatility that I think is worth being aware of, and these graphs do a good job of illustrating that, and that's the term structure of volatility. And what that means is that when you go out to different expirations, out the expiration curve, if you will, in other words, the shorter, the options with shorter days to expiration versus options with longer days to expirations tend to trade at different implied volatility levels. Now, I picked this date, obviously, for an illustrative reason as well. And as you can see on the top, I did this on October 23rd of last year. If you think back to October 23rd of 2020, the big event that, certainly the United States and probably the world was looking at was who was going to win the November election of last year. So what you see here is that the option that expired, and I've got my cursor over here, and it's denoted by E1CXO, which is a cryptic way to say the first November weekly. So the option that expired right after the election is trading at a much higher volatility than the 3 expirations before the election, right? The idea being that the election was sort of so dominating what was going to happen in the market that the option that expired right after that election just had a lot more potential futures price move, and therefore, again, the implied volatility was higher. So in other words, if I was selling options, I was demanding more premium to sell you an option that expired after the election, where everyone assumed that equity and really all asset class prices could really get rocked by what happened in the election. So again, I'm going to demand more premium. That's higher implied volatility. So again, this is, I show some of the different expirations, not all of them in the E-mini options on this screen. But I think this is a good illustration just because of the exaggerated, elevation of that, near to the election option. I obviously chose this one, but all options have different term structures. And again, this is all information that's available on our website for free. So if you're trading options with, and you're looking out the expiration curve, well, you probably want to know what's the implied volatility of the different options that I might be trading. And this is a pretty good illustration of that. So this tool I think is kind of slick. It basically uses the concept we just went over, which is term structure, to try to isolate the impact that an economic or global or socioeconomic event might have on the futures price of a given product. So in this case, we're looking at, you can see up here the NQ, which is the NASDAQ, E-mini NASDAQ. So we're looking at the March of 21 E-mini NASDAQ futures price. And what this tool is called is, we call it the event volatility calculator. So what I did here with this black line, you can see, is that I chose an expiration of February 5th of 2021, which I believe was a Friday employment number. So what I said was, based on the employment number coming out, the jobs number, if you will, that comes out every Friday and a lot of times has market moving potential, what move in the futures price is the option assigning to that number release? So what we do is we go back and we look at the term structure that's on this graph. And based on the difference between the expiration that is in question, in this case, the Friday jobs number, and the expirations around it, and the volatility of the expirations around it, we try to isolate the impact that that jobs release number is going to have on the futures. And in this case, what it's telling us is that in February, the options market was assigning about a 34-point move. And again, remember, implied volatility doesn't tell you a direction, but the options market was assigning about a 34-point move in either direction to the futures price based on the release of that jobs number. So I think this is kind of a cool little tool to tell you how much sort of premium the options market is putting in on a given, numbers release. And it could be CPI, it could be PPI, it could be an election, things like that. In this case, like I said, we use the jobs number. But again, I think this is good information to have, even if you're not trading options, because if you're trading futures, well, this tells you at least what the options market is pricing. And does it mean it's going to move 34 points? Of course it does not. But that's what the options market is pricing in. So I think, in my opinion, that's pretty good information to have. This one I put up just because I think it's a neat picture because of all the information that it tells you about a given market. So in this case, we've gone back and we're looking at the E-mini S&P 500 March of 21 option, and you can see that ESH1 up there. So you can see kind of a standard bell curve on this. So the first thing this is telling you, and again, it's using implied volatility, it's telling you, and you can see in these pink boxes here, that within one confidence interval or one standard deviation, the options market is pricing in a 273-point move in the futures from the time I did this until expiration. So you can see that when I did this on February 3rd, you can see up on top here, February 3rd, there were 44 days until expiration, and the at-the-money volatility at the time was 21%. So based on all of that, what we're saying is that with one standard deviation, the options market is pricing in a almost 274-point move over the next 44 days in the S&P future. And then two standard deviations, we go up to 520, and then up to over $700 when you start to have those sort of tail event moves, those three standard deviation moves. We're pricing in even a bigger, obviously bigger move in the future. So it tells you, how much of a move the options market is pricing in overall. What it also does is it tells you with these blue and yellow lines where the volume was on this particular day. So you can see the puts are yellow, the calls are blue, and naturally, as you might expect, as you kind of get into lower delta out of the money options, as we move left with the puts on the yellow lines, you can see that, where people were trading, what strikes people were trading at. You can also see that, puts greatly outnumbered the calls on the day that we looked at. So there was a lot more volume in the puts in this particular contract than there was in the calls. And I think what is also interesting is you can kind of see the deltas. So this is a 15 delta put here, and it's a 5 delta put way over here on the left, so very low delta. But you can see like people were trading a fair amount of the pretty low delta, like I call it, under 10 delta puts, which are only going to come into the money if the market has, as you can see there, a 3 standard deviation move. So again, it doesn't tell you where the market's going, but it's a lot of good information, I think, about what's happening in the options market. And this one is a little bit different because it's not a volatility tool, it's a correlation tool. And what this allows you to do is do real quick price correlations among all of our products. In this case, I picked our equity index products, so the S&P, the NASDAQ, the Dow, and the Russell 2000. And what I'm showing here is that if you looked at the correlation among those 4 stock indexes, and it's hard to see, I know, but if you looked at it from November of 2019 to November of 2020 when I did this, you can see a very strong price correlation really among all 4 indexes. But then I looked at just 1 week, 1 week of correlation in November of last year. And if you remember what was happening in November of last year, it was when the vaccine had started. The good news on the vaccine, aside from the presidential election, of course, what was happening was we started to see some good news on the vaccine front, and it looked like, and all of a sudden it looked like we were going to have a vaccine sooner than anybody thought. And all of a sudden it was you started to get this sort of rotation, they called it, out of the quote stay-at-home stocks, which the NASDAQ had outperformed during the sort of lockdowns, and then into the Dow and the Russell, which had kind of underperformed as the economy shut down because of the COVID pandemic. So all of a sudden you saw where NASDAQ had an 88 and an 80% correlation to the Dow and the Russell over that last 12 months. It actually went negative during that week. So it's an interesting concept to know about, particularly if you're trading what we call spread trading, which are relative value trading, which a lot of professional traders do, wherein instead of just making a trade based on, let's say, the S&P going up or down, they'll make a trade of the S&P based on where it is relative to the NASDAQ or the Russell. And so as you can see here, if you're doing spread trading, you want to know where that correlation is. And not that it's going to come back, of course, right? When you see that strong correlation completely break down and go negative, it doesn't mean it's going to bounce right back. Of course not. But it's good information to have if you have a theory that maybe the market overdid itself. So the NASDAQ got sold off more, relative to the other stocks than it should have, and that correlation is going to bounce back. That's a trading idea. And again, of course, it doesn't mean that it's going to come back, but this is a nice tool to see, how different products are correlated to one another at any given time. And as you can see here, you can customize the time period that you want. And then, we just looked at a lot of different equity products in the last few slides. So I just wanted to point out the different equity index futures and options products that we list at CME. And as you can see, we list futures on the S&P 500, the NASDAQ, the Russell, the Dow. And on the S&P and the NASDAQ, we launched what we call micro E-mini futures and actually options now on both of those indices that, the success of which has been very well publicized, and we're trading well over 1 million to 2 million, and I think even sometimes 3 or 4 million in a given day in the micros, which is really kind of an unprecedented success for a new product that we just launched in May of 2019. So it's kind of like there's something for everybody. The E-mini is a fairly large contract in terms of notional value. The micro is 1/10 the size of the E-mini in all of those four different futures. So, and then we have E-mini options on all 4 of those indices, and then we have micro options on, like I said, on the S&P 500 and the NASDAQ. So now we're getting into another tool that we call a price action alert. And the beauty of this tool is that it's not so much that you can sign up to get alerted when one of the CME products moves by 1, 2, or 5%, which you can, or when it reaches a certain technical indicator, which you can. That's what this tool does. But the beauty of this tool is it doesn't just tell you when that happens. So you don't just get an alert that says, hey, the E-mini S&P is down 2%. What it does is it filters out those kinds of price alerts, but it also looks back historically 1 year, and it tells you that every time that event happened, what happened in the market 1 to 5 days later or 1 to 5 hours later. So in this case, what we've got here is it says, if you were signed up for these alerts, which again, you can do on our website, it says E-mini S&P 500 trades 1 standard deviation above its 5-day moving average. So you've already gone in, you've set up your alert, and you've said, if this happens, alert me. So you get an alert that says, hey, this just happened. What you also get is it says, you can read here, when this has happened over the last year, which has happened 44 times, in 39% of those times, the price declined 5 hours later. In 61% of those times, the price increased 5 hours later. And then tells you, a little bit more detailed information about those events. So that's kind of the beauty of this tool. Now, does that, again, and I got to keep saying this, but does that mean the price is going to go up? Of course not. Of course not. But it does tell you that over the last year, when this event's happened, it's gone up more than it's gone down. And then it also tells you the details of, by how much it's gone up or down. So again, as individual traders, we're all our own research departments, right? We're not at a bank where there's an entire research department to give us trading ideas, or a hedge fund, or a prop group that's got a lot of money and technology behind us and things like that. We're our own research department. So again, this is just more information, and in my opinion, you can't get too much information. So again, this is just another tool. I wouldn't ever suggest blindly following it, but it's more information that I think can be used as part of the trading decision. I'm going to see if I can toggle this is a tool that I think is important to showcase, and it's elegant in its simplicity, really. And what it does is it tells you all of the different expirations that we have in a given options market. So in this case, I'm looking at the E-mini S&P 500 options. And what it shows you is all of these different symbols in the different calendar dates are options expiration. So I can trade an option that expires on any date that has one of these symbols in it. But not only does it tell me what the different expirations are, if I click on it and then I look over to the right, it's going to tell me the information I want to know about that option. So I've looked ahead a couple months here, and I'm looking at the first weekly in June, which has 59 days until it expires. It tells me when that's going to become available to trade. It tells me that it's a European option versus an American option, which is good to know because they're priced a little bit differently. It tells me actually exactly what time that option expires, which is 4 p.m. Eastern time, 3 p.m. in Chicago. And all of the different information, what the tick size is, what the trading hours are. And further to that, it tells me the information about the future that it's based on. So this particular option is based on the June future, which expires in 73 days. So now I know that if I trade this option that expires in 59 days, and I'm in the money and I hold it to expiration and I get a futures position, well, that futures position is going to expire, 14 days later, 73 versus 59. So I think that because we've added so many options expiration, which has provided a ton of flexibility for people to gain exactly the exposure they want to different products at CME Group, it's also added a little bit of complexity in that there's so many expirations, you got to keep them all straight. And this is a really simple but slick tool, I think, that allows you to know kind of all the information you want to know about how an option expires, what the style is, what time it expires, what future it's based on, when the future expires, all in one tool here. So I think this is, like I said, it's a simple tool, but I think it's an important one. And that's the contract directory here. This is just a list of some other volume and open interest tools we have. I'm not going to go into all of them. In fact, I'm not going to click on any of these, but we have a week in options report that basically summarizes what happened in a given week in a given option product. We have an open interest heat map, which is a pretty slick tool, which is a very good visual of where the open interest in a particular option product is being held. So, sometimes they refer to a strike that has a lot of open interest versus the other strikes around it is, a death strike or different words for it. But some traders put meaning into a strike that has a lot of open interest, and this is a nice visual of where the open interest is held in a given option product. It tells you what the most active strike is. There's another tool, what's the most active strike in whatever I'm trading. So it just tells me where most of the activity is happening. Where do the traders see, where are they seeing the activity? And then the commitment to traders is actually published by an industry group, FIA or CFTC, I can't remember to be honest. But it tells you which customer category is holding a lot of open interest in a given product. So it'll tell you our asset managers net long or short treasuries, or our commercials net long or short agricultural products, or things like that. So again, it doesn't tell you where the market's going, none of this does, but it's, again, more information that I think can only be helpful. So now everything that I've shown you up until this slide has been applicable across all 6 asset classes that CME lists. This tool in front of you is actually a tool that we've developed that's specific to treasuries. And there's a lot of information on one page, and some of this stuff is clickable to get into even more detailed information on, on what it's showing you. So the top left here is an interesting one. We call it the FedWatch tool, and if I were to click on these 3 lines, it would bring me to the actual tool on our website, which has more detailed information about this. But basically, the FedWatch tool has all of the different FOMC meeting dates, and then it tells you what the probability is that the Fed, the Open Market Committee, is going to change the target rate on the Fed funds. So, when I did this slide, you can see that the market was signing a 0% chance that the Fed would move rates in March, and it didn't. At the time I did this, it was assigning a 2% chance, which is actually up from 0, a number of months ago, that it would actually raise rates from its current, basically 0 to 25 basis points in the April. So if I were to click on this, the FedWatch tool actually gives you a more of a historical view if you want it, and a couple different ways to look at this. And it's a slick tool to look at, and it's all based on the price of our Fed fund futures market. So again, I think that's kind of a slick little tool. These are, you know, if you look at this, this tells you what the future treasury price is compared to what the yield in the cash treasuries are. So, you know, at the time I did this, this is giving you the on the run yield for the 2-year, 3-year, 5-year, 7-year, and so on in the cash US treasury market. Now futures, and I'm not going to get into how futures treasuries are priced. It's a little bit complicated, but there's what we call an implied yield in a futures contract. So it tells you kind of what the implied yield in a 3-year future is compared to the cash on the run. And again, these 3 lines mean that I can click on it and I can get historical futures yields. I can get the shape of the yield curve, the futures yield curve, a lot of pretty good information. And then I'm not going to go into a lot of the other stuff. It's, you know, here's some reports that you'd want to be aware of in the treasury market. Here's the Fed balance sheet, which is kind of cool. I was playing around that with that this morning, and you can kind of see the spike, the huge spike in the Fed's balance sheet with you know, with the money that we've printed because of the treasuries that the Fed has bought as a result of the money that we've issued because of the pandemic relief. You know, really kind of unprecedented, you know, when we kind of talk about trillions as if it's not even a big deal anymore. If you remember 2009, we couldn't believe that the government was going to bail some banks out with billions of dollars. Now we're talking about trillions, it seems like every other week. So, you know, and it's you know, that issuance of debt is also a good reason that I would point out that we do have an entire suite of treasury futures and options that really could become interesting products to trade over the next year and beyond, as you know, we're kind of seeing what I think is kind of an unprecedented experiment in MMT, or modern monetary theory, which suggests that we can just keep printing money. But we've already seen some fairly volatile activity at the longer end of the treasury curve over the last couple months, and you know, we think that that could really continue and even become exacerbated as we continue to print money here in the United States. So the treasuries could become an interesting product to watch, you know, now and over the next couple of years, I think. This is a tool we call the OPEC Watch tool, and what we do here is we look at the WTI crude oil, mostly the options market and volatility. And again, we talked a lot about volatility, and from that we try to come up with an estimate on the probability of what the OPEC, I think they call it OPEC Plus now, is going to do at each of their scheduled meetings. So in this case, we were looking, when I did this slide, we were looking at the December OPEC meeting, December of last year, and based on, you know, the model that we have, and by the way, the math behind all of this is available. When you go to look at these tools, you can click around and find the math that we're using to come up with these percents. But based on the model, what we were saying was that there was an almost 12% chance that OPEC would increase output, an 81% chance that it would maintain its cuts, and then about a 7% chance that it would actually cut its production more. So again, if you're trading oil, that's pretty good information to have, I think, because obviously, you know, what OPEC decides at its meetings, we saw this just the other day actually, can have a pretty substantial effect on the price of WTI crude oil, and also volatility, right? A lot of times we saw, I think it was on Monday, Thursday, I can't remember, volatility really dropped after OPEC made their announcement on what they were going to do, because that uncertainty was taken out of the market. So again, this is just another tool, very valuable, I think, if you're trading our energy products. This one's a little bit more complex. I'm not going to get into it, but it basically compares the cost of futures versus ETFs based on what we call implied financing in futures. And, you know, obviously I chose this particular moment in time. Futures were trading what we call cheap relative to ETFs. That's not always the case in the name of full disclosure. But if you're looking at, you know, the SPDR versus the E-mini S&P 500, this tool, which we call total cost analysis, shows you how much you might be saving by trading futures based on different finance scenarios versus the cash ETF. So I just thought I'd include this one because I think it's kind of a cool tool if you're trading both asset classes or contemplating trading one or the other. And finally, I think this is the last tool I have, and it's last not because it's not a good tool, but because it's brand new. And I added it after all of the other ones. And what we've done is we've basically taken the volatility, implied volatility in, I show the 10-year and some currencies here, but now we've expanded it to almost all of our asset classes. If you go to the CVOL page at CME Group's website, you can get it on, I think 5 of the 6 asset classes now that we list. But we've taken implied volatility across the different strikes in these different products, and we've come up with a volatility index for those different products. And so rather than looking at, like when we were looking at the skew, we were looking at just the 25 delta, or we might look at the money sometimes as a proxy for volatility. We've basically taken the entire spectrum of liquid strikes in a given option and come up with the volatility index, which we think is even a more representative measure of what the volatility in a particular product is. So if we look at the 10-year here, there's a lot of information just on this little box, right? So this, the green and red bars here give me the last 5 days of the CVOL index, which doesn't tell you what the volatility is. It's an index number. But in the 10-year, you can see it was 58.4, and over the last 5 days, it was up, it was down, it was up, it was up, it was down. It tells you kind of what the pattern for implied volatility has been in the 10-year. You can see up on top here, we selected 6 months of data. So what that tells you is that over the last 6 months, and we can change that if we wanted, the low in the CVOL index was 45, the high was 86, and it's currently at 58. So it tells you we're sitting a little bit closer to the lower part of the last 6 months of volatility than the higher end. It tells you kind of the same measure for puts here, what we call down VAR, and I'm not going to get into the math behind all of this, and then the calls on the up VAR. And then similar to what we looked at with the corn skew, when we looked at the risk reversal, this is giving us a measure of the skew in the 10-year, which is, a positive skew. It's a similar thing to what we did in the risk reversal, but it tells you that in the index here. Now, that to me is even a lot of information, but if I were to click on this, it would actually bring me to a page where I could chart this historically. I could chart the implied historically. I could chart the skew historically, and really kind of dive into this even more. So I think these are, like I said, these are pretty new products for us at the CME, and right now they're calculated once a day at the end of the day. But you can envisage a time when we calculate them more often to get an idea throughout the day of what this quote CVOL index is in a lot of our different products. And again, I show only the interest rate and the currencies here, but we've now expanded this. Since I did this slide, we've expanded this to almost all of our different asset classes. So this is I think a really cool volatility measure. We think it's a unique volatility measure. And again, we developed this, it's a proprietary index. We developed it in-house. So I think it's worth checking out. And I should mention that a lot of the tools, almost all of the tools that I looked at today are developed by a third party that we have a contract with called Quick Strike. And so if you go to CME Group's website, Quick Strike is going to be prominent on the tool section of the website because it's, like I said, it's a third party that we have a relationship with, that we developed a lot of these tools with. So I would be remiss not to point that out. And finally, just here's some different tools or different resources that we have at CME Group on our website. We have a daily newsletter where we write an options piece almost every day. And then we have some videos and some news articles in there as well. Like I said, the editorial part of the newsletter is a piece that's primarily based on options and primarily based on quick strike volatility tools. So, that's called In Focus, and you can sign up for In Focus on our website as well. And the last thing I want to point out, and it has nothing to do with any of the tools that I talked about here, and hopefully you've seen the announcement, is that CME Group will be launching a micro-sized Bitcoin future in the beginning of May, which will, the size of that futures contract will be 1/10 of a Bitcoin. So whereas today's Bitcoin future is 5 whole Bitcoins, which I think at the current prices is about a $300,000 worth of Bitcoin contract, this is going to be 1/10 of a Bitcoin, or more like a 5 or 6 or so, wherever Bitcoin happens to be, $5,000, $6,000, or $7,000 contract. So it's an exciting product launch, and I wanted to point that out before we got into any questions that there might be. So that's my presentation. Let me see if if there's any questions here.
So Craig, thank you very much. Hold on there. I am going to make you an organizer so that you can also see the questions. Just 1 second. Now you should be able to see the questions, Craig. Raz asks a question, the last question there, Raz. I think, Raz, you went to the same business school as I did down in Winter Park. He asks, which tool is the presenter's favorite?
I think, you know what I like are some of the first tools that I showed, which give you the implied volatility in these products in historical context, because, and in the name of full disclosure, I'm not allowed to trade futures nor options on futures because of my position at CME Group, but I'm allowed to trade options on equities, and that's information that to me is not readily available anywhere. Like if, for example, I wanted to find out, the daily historical implied volatility on Apple or any individual name stock option, to me, that's not something that I can find easily. And so I think the ability to look at where the current implied volatility sits relative to the past, and going back years, the way I showed on I think the second tool slide, I think is really valuable, because like I said at the beginning, implied volatility by itself doesn't really mean anything, right? Implied volatility in Bitcoin's generally always been higher than in stocks. But when you get to see it, and I said generally, I'm sure there may have been one case that may not have been, but when you get to see it in a historical context, I think that's really where it becomes important. So I think that, that historical database of implied volatility is pretty important.
And just to reiterate here, Solomon asked the question, is it possible to listen again to this recording? I guess for people who just don't tire of your voice, Craig. But we will, yes, Solomon, to answer the question, yes, we will have the link to you in a couple of hours once we can get Craig off the stage, which is proving difficult. But yeah, have that in your inbox, and it's going to be available at ivkr.com under the education menu on our new webinars page. So Vladimir is asking the question, this is a real setup. Did you stage this one, Craig? How to get access and what's the pricing plan?
So if we're talking about the tools that I showcased here, they're free. And like I said, I didn't show anything on here that's not available for free. And I'm not here to sell QuickStrike either. But like I said, we did develop a lot of this with a group called QuickStrike. I think it's Bantix, B-A-N-T-I-X. And they actually have even more robust functionality if you wanted to pay for it, but that would be through them. And again, I'm not here to promote them, but I do think I'd be remiss not to point out that there is actually even more robust functionality that's available outside of our website. But everything I showed here is for free, and the URLs I think are throughout this presentation. So if you click on any of them, it's going to bring you to the section of our website where you can find, that we've aggregated all of this really in one section. So clicking on, I think really any of those, again, URLs that we have on the different slides will bring you to the place you need to be to find all of this stuff.
Okay, and when you say clicking on the slides, let me just remind attendees, The handouts are available from both the Interactive Brokers website as well as in this go to webinar panel. If you click the handouts, you'll see the link to the PDF, and that's interactive. You should be able to click through those links. Thank you, David, for confirming that. He's got them perfect. So I'm just going to back up the screen here a little bit, Craig, because there was a question which from Jacob. He says, why should anyone other than an institution trade futures? He's not currently a futures trader, but how would you pitch that? And I guess let me just kind of start the ball rolling there. I mean, you know, I came from institutional trading back in the 90s, and some of those products are, you know, very, very well trafficked by retail traders these days, right, Craig?
Yeah, you know, I think, and I mentioned this when I had our disclaimer slide on the screen early in the presentation, that, you know, we do understand that futures are different than, you know, other things you might trade like stocks or even stock options. They have different expirations. Even the futures expire. Some expire into cash, some expire into the physical commodity, and, you know, with different dates and stuff like that. So we do understand that there is some complexity to futures that we absolutely would encourage anybody that's contemplating trading futures to research before they actually got into it, because those things can, you know, they can be a painful lesson if you don't know them. However, what I would say is that once you do know them, and they're really not, it's not splitting the atom stuff, it's really just knowledge, it's really just kind of reading and exploring how they work. But once you do have the basic mechanics, I think some of the benefits of futures are, one, obviously there's inherent capital efficiencies where, you know, you have to deploy the capital to the extent that the margin's required on a future, whereas, you know, on stocks, even at Reg T, you have to put up 50% of what you own. So there's some capital efficiencies I think you get in futures that you don't get in a lot of other products. I think the 24 by, you know, call it 24 by 5 nature, where our markets are open from Sunday night until Friday night. You know, the world isn't flat, right? And what happens during Asia hours impacts Europe, impacts us. So I think the ability to get at your position and get at the markets, you know, around the clock, I think is an invaluable benefit of, or, you know, aspect of futures. You know, and then there's a diversity of asset classes. Like I said, you can trade anything from, you know, things with feet like pigs and hogs to, you know, the London interbank offer rate, short-term interest rate, right, and everything in between. So there's a wide variety of different asset classes within futures, and they all have different volatility characteristics, you know, that at different times might be, you know, might represent a better trading opportunity. So, you know, I want to be completely honest, and we do acknowledge, you know, the complexities in futures, but we do also think there are some benefits. And then, you know, beyond that, I mentioned in my slide, we've introduced micro equity futures. You know, we introduced that in May of 2019. We also have micros on our currency products. We have micros on gold and silver. We have a mini product on the WTI. And so all of these are smaller versions of their sort of bigger brothers, and do represent kind of a, you know, a way to get into these markets in a smaller way where you can, you know, theoretically be exposed to less risk. If you know, if you do one micro, it's 1/10 the exposure of a mini in equities. So they do represent a way to sort of get into the markets in a smaller way, you know, particularly as you learn futures.
Craig, I think we may have lost you there momentarily.
Oh, can you hear me?
Yeah, that's better. Yep, carry on.
Where was I?
We didn't miss much there.
Okay.
That's better. Well, let me just kind of back up to another couple of questions that have come in. And of course, you're not going to recommend a trading platform, but David asked the question: can all of these products be traded on IB? The answer to that is yes. I don't know of a futures contract that is an electronically traded futures contract that isn't available. And I would certainly say, you know, for 24-hour global access trader workstation is exactly what you'll need. Hassan now seems to have located the PDF, and yeah, the link to that will also be available on the webinars page. Jacob asks that living in Asia, the information you've provided so far, Craig, is really useful. Is the CME Group website in the slide deck a good starting point for understanding futures trading, or are there other places that you'd go, or is there another CME site that would be better? I mean, in this day and age, I'm pretty sure that the CME Group website is going to have sufficient information, Craig.
I think so. I mean, I would say the URLs that I have on the slides, and then also if you just were to Google CME Group Institute, that would bring you to our sort of education portal, and we have a ton of information. I think that's a great starting point, and I know, in fact, even Andrew and Interactive Brokers has actually put some of that stuff on their education page. And then beyond that, Andrew, I think you have even more information on your page as well. So I think, you know, the combination of those two would be a great place to start.
Yeah. So from the education menu on ibkr.com, just look up the Traders Academy, and as Craig mentioned, we've got many. I mean, the CME is kind of the king of this. You've got so many fantastic video courses and lessons available on your website. We've simply borrowed several of those and put them onto the Traders Academy. But yeah, if you want to get underway in futures trading, either of those venues will be good. Craig, is there anything? I don't think we've got any additional questions there. Is there anything you want to add?
No, I think there were good questions, and I appreciate everybody's time. I hope everybody got at least something out of it. Hope everyone found at least one tool that they're going to go look at, because I do think that there is some valuable software stuff out there that I went over. So again, thanks to everybody, and thank you, Andrew and Interactive Brokers, for giving me the opportunity.
No problem. No problem. Craig, thanks for taking the time out of your day to come and present to us. We had a good turnout here. Again, the recording will be in your inbox in a couple of hours' time. Look out for that. And thanks to Craig and everybody at the CME for working on this webinar program with us. We definitely appreciate it, and we look forward to having you back next month, Craig.
Sounds good. Thanks again.
All right. Thanks, everybody. Bye for now.